U.S. large cap growth stocks have been on an absolute tear, going up 15% per year over the last 10 years on average. Last 5 years, they've gone up 17% per year on average. And this year so far in 2024, up until August, mid August, they're up about 18% this year already. But will this continue? Are these the best growth stocks for retirees and others over the next 3 to 10 years? Hello, my name is Tommy Cloud, and I am president of Third Act Retirement Planning, a company that I founded back in 2000. I am a certified financial planner and qualified kingdom advisor. And what I do is help people that are Christians who have recently received a large sum of money to make biblically wise decisions. In this video, we're going to discuss the best growth stocks for retirees in 2024. Let's go ahead and dive in. So what we want to talk about briefly is just the difference between growth and value before we continue this discussion. Growth stocks are companies that are expected to grow more than average companies that are being traded on the stock market in the future. Whereas value stocks are companies that are undervalued compared to other stocks in the market based on their price to earnings ratio, usually, but also it could be their price to book ratio or their price to sales ratio. We're not going to get into defining those ratios in this video. The other thing we want to look at with growth stocks, they do favorable during economic conditions that are expanding and growing, where the economy is doing well and it's not in a recession mode. Value stocks are the opposite. They perform better during recessions and periods where the stock market is not growing as much. You also have with value stocks that historically they have outperformed growth stocks. And they do tend to perform well during periods of inflation and just broad general earnings growth. All right, wanted to quickly here look at some research that was provided to me by the Lincoln Financial Group. And just notice I've got my readers back on to help me see this chart. But you can see going back here, I guess on your chart, you probably can't see it, but I guess 93 is where it picks up for you because of me being down there in the corner. But this chart goes all the way back to 84. And if you would please just send me an email if you'd like a copy of this particular chart. And I'll probably put it down there in the link below. All right. Had to put my readers on to see this chart with you guys. This is some research that I received from Lincoln Financial Group. And what we want to do here is look at growth versus value. The leadership rotation is what they're calling it from the past. This chart goes all the way back to 1984. I'm sure you can't see it because of my picture down there in the bottom. And that's one of the reasons I'm going to make this chart available to you. One of the links below. Let's go ahead and look at that though. If you go back, you can see right here where 93, 95 value did better and then growth did better all the way to about 2001. Then from 2001 to about 2008, value did better. And then really since 2008, it's been the growth show. And that's where you want to stop and think if value stocks have historically done better, and we can see that they have. Value stocks for large cap have done about 0.5% better. I'd say that's about 0.5%. And then for mid cap, value has performed about 2.5% better per year. And then for small cap, value has performed about 4% better per year. So we're beginning to think to ourselves, okay, so what are the best growth stocks for, in particular, retirees in 2024? We're beginning to start to shape our opinion. Okay, so before we hone in on what the best growth stocks are for retirees, we got to narrow it down. We got to start our investigation. Let's start back in 1972 and look at the performance, the historical performance of different types of sectors. So this is 52 years, going back 52 years. And we really want to see how they performed. If you look here, I broke it down initially into, we start up here and then we'll come down. Large cap value, large cap growth, and the same for mid cap and small cap, just breaking those down. So you can see historically that the US small cap value and mid cap value have been the best performers over the past 52 years. However, as we've talked about, this large cap growth made up of these huge Titanic companies and particularly with NVIDIA doing so well and just skyrocketing and driving up that large cap growth index, along with Apple, Amazon. A lot of these companies are technology companies, Microsoft. And you can see that large cap growth has just been astounding. It's up 17, almost 18% the past 5 years. It's up 15% the past 10 years. And even this year, it's up 18%. And this is for the month ending July of 2024. Now, if we want to know what type of companies make up the growth index, we'll just go over here and look at the Russell 1000 growth index. You can see that it's going to, again, be these type technology companies. Only Tesla and Amazon are non-technology based companies, along with Eli Lilly there, that are in the top 10 holdings for these large cap growth companies. So we really want to look and see, okay, if these companies have done so well here recently, the past 5 and 10 years, don't we just want to go ahead and keep looking at them and stay invested with them? As you can see, the long-term average of the large cap growth since 1972 has been about 11%. However, recently they have outperformed that. These stocks have outperformed by 7% per year over the past 5 years. So that to me is a red flag that maybe there's some things going on that we need to be aware of before we just continue blindly buying large cap, in particular technology stocks. Okay, I've got my readers on to help me read this chart with you. Let's look at this chart that was created by Lincoln Financial here, 2024. And this was created, as you can see, the data was through June 30th of 2024. This chart goes all the way back to 1984. You probably can't see that because of my image. So I'm going to provide a copy of this chart in one of the links below the video. But what I'd like you to do is look back here. This is about 1993. You can see from 93 to about 95, value did better. And then from 95 to 2001, growth outperformed. Then from 2001 to 2008, value outperformed. And then since 2008, really, it's been a growth show, which makes sense because we've been expanding as an economy. And again, the growth sectors are communication, technology, and the value sectors are more the financials and the real estate and the utilities. So this kind of gives us a clue as to what might be the best type of stocks for retirees moving forward in over the next 5 to 10 years. Let's continue to shape our view on what type of stocks we want to pick out. Okay, so let's see what else might be attractive for retirees to purchase right now. As we look here, this is going to go back to January of 1986. And the reason why it doesn't go back as far is because for this particular chart and information and data, we are going to use, as you can see down here, the global stock market, excluding the US, and then the international developed, excluding the US. And a lot of this international developed is Europe, but it's also going to be Asia and Australia. And then this includes everything, and it's mostly made up of Europe and Australia. That's why the performances are so similar, but it also includes underdeveloped countries like in South America and South Africa. So as we look in India and countries like that are going to be emerging markets. So let's look at what we're doing here as far as the US large cap versus small cap. Okay, so we looked at kind of what we saw with value stocks and growth stocks. We kind of look at that in the US. This particular data that we're going to look at is it only goes back to January of 1986 because it uses data from international indices. So we're going to look at international stocks now and continue to kind of shape what type of stocks might be best for retirees here in 2024. We can look down here and you can see the global stock indexes have been added. And you can see their performance long-term since 1986 has been lower than US stocks. And they have also gone back for themselves. They've also, past 3 years, they've underperformed what they've even done themselves. The last 3 years, international developed countries, which would be Europe, Asia, and Australia, you can see has done about 2.75% a year versus their long-term average of 7% per year. So that is really, really a big difference. That is a 4 That is 4.25% per year difference that we've seen over the last 3 years. And then even here over the last 10 years, we can see that it's almost a full 2% lower in the international development. Now, the 5 years about the same because 4 or 5 years ago or 6 years ago, there was probably a year that was really big in there that drove this number up. So we want to continue to investigate these international stocks. And you can see more research here from Lincoln, international valuations and dividend yields. You can see this is the price to earnings ratio that we talked about, and this is the discount. So this is the difference between the international price to earnings ratio and the US average price to earnings ratio. And it's for the next 12 months. And they're just talking about the S&P 500, which is the large cap stock. And you can see that as of right now, in August of 2024, the current P ratio is about 21 for the S&P 500. And then the rest of the world's 13.5. And whereas if you look at the 20-year average, it's really right around where international stocks are only about 16 or 17% cheaper than US stocks on average. Now, when I say cheaper, that's as measured by the price to earnings ratio, which we're not going to get into defining that in this particular video. However, right now, if you look, as we sit here today or close to it on June 30th of 2024, there is a full 35, almost 35% discount on foreign stocks as compared to the S&P 500 stocks just using the price to earnings ratio. It's all the way down to 13.5 versus the S&P at 21. Additionally, let's look at the yield. You can see historically the yield on the S&P 500 stocks has been about 2.1% right here. And then the current yield's all the way down to 1.4. But with foreign stocks, it's been about 3.3 historically. And currently their yield is 3.2. So their dividend yield hasn't come down. Those companies haven't started paying people less dividends to attract them in. So now we're also a full 2 standard deviations where the average has historically been where foreign stocks are going to pay about 1.2% more per year in dividend, as you can see right here. Now we've got this huge spread of 1.8%, which actually ends up being another 2 standard deviations, which is tremendous. It usually will point to a change or a shift in the performance that would lead to foreign stocks outperforming the US. You can see going back to the early 70s on this chart that and I'll provide these charts as well down in the link, but you can see that foreign stocks, anytime you see purple here, that means that the developed countries, Eastern Asia and the Far East, or Australia, have outperformed the US. And you can see that there is a lot of purple up until about 2008. And we're looking at about, 16 years here that foreign stocks just haven't put together any type of run against the US. So that's another clue for retirees, maybe in 2024, on what type of stocks are going to be the best for growth moving forward. Okay, so we've narrowed it down to US stocks that are not only value, but also small cap or maybe even mid cap. We're going to look at that in a second, and international stock. I think those two offer the best opportunity for growth. But let's dive in and look at how to. Okay, so let's go ahead and look at how we're going to actually find these stocks. We have here, as you can see, we're just going to narrow it down to large cap, mid cap, and small cap value because we narrowed in that value is probably a much better opportunity than growth right now for the next 3 to 10 years. So large cap has done 11.25% per year on average since 1972. That's about the last 52 years, we'll call it. But its 10-year average is 10.39. So that's almost 1%. That's not that big of a discrepancy. The last 10 years, large cap stocks have been pretty close to what they've done the previous 52 years. So we don't anticipate that generating any type of extra returns. However, mid cap value, if we look right here, you can see has done 12.62% since January 1st of 1972. But the last 10 years, it's only done 8.86. So that's about 4% per year that mid-cap values have trailed the past 10 years versus what they did the past 52. So that's a huge opportunity if mid-cap value stocks begin to revert back towards their average. And then we look at small cap stocks. They've done 13.61% over the last 52 years through August of 2024. And yet the past 10 years, they've only done 9.17. So now we're getting up to about 4.5% per year that US small cap value has underperformed. And that's pretty substantial. So let's get into specifics, which is about what this video is. So what we want to do is my 3 favorite fund families for mutual funds or ETFs is Dimensional, Vanguard, and Schwab. They're very low cost. And that is if you're not getting into the biblically responsible investing. And we'll get into that in different videos. But this is just in general. So what we want to do is we want to go find these small cap and mid cap value stocks in the US. And we also want to find international funds. So let's go ahead and jump over here to what we're doing on Dimensional. And with the Dimensional funds, you just go up here. It's real simple. We've got all regions. Okay, we're going to click the US. We're going to click value because that's what we want. And then we're not looking at large, so we're just going to click small. And that's about it. We're just going to stick right here. The ticker symbol is DFSV, or if you want a mutual fund, it's DFSVX. And these are small cap value. Now, Dimensional, you can only get through financial advisors. However, I did mention Vanguard and Schwab, which I like a lot too. So those are options without a financial advisor you can do on your own. So we'll just come right over here to Vanguard. And as you saw, Dimensional did not have a mid-cap US value. However, Vanguard does. This is ticker symbol Victor Oscar Echo. So you can just go in there, get that. That gives you the mixed stock value. That'll give you some those stocks, which we've pinpointed as great growth opportunities during the next 3 to 10 years, most likely, but not guaranteed. And then, of course, we go over to Schwab. And Schwab, we get here, they don't have any value. Schwab doesn't, except large cap. We're not doing large cap. We decided that wasn't a big enough opportunity. So what we're going to do now is we're going to look at international. And with international, Schwab does indeed have a developed nations one. This doesn't have a lot of the emerging markets. They have their emerging market down here. You could really combine these. One thing to be careful of, you do not want to get the international dividend or international value. You just want to get one like this right here, SCHF. And Vanguard has one as well. I don't know if Dimensional does, but that kind of gives you an idea. So what about if you want individual stocks? Okay, that's real easy. And this same thing I'm about to show you can be done for mid-cap US value, small-cap US value, and I'm about to show you international using a Schwab ETF. So if you want individual stocks, I'm clicking on the Schwab ETF. It's real easy. I'm just going to click on portfolio. I'm just going to simply scroll down, and there's the holdings. So you just go right in there. There's your ticker symbols, and boom. If you want to buy these holdings, you can go in and buy. You can click here, even view all holdings. You can go right on in there, and you can see their holdings. Toyota, you probably recognize some of these. Royal Bank of Canada. I don't know. Wait, here it is. I'm sorry. You can see Toyota, Royal Bank of Canada, some of these here. So you just jump right in there, and if you want individual stocks for yourself, you can go in there and start buying them like that. There's also another way that you can get access to these stocks other than ETFs, mutual funds, and then, of course, just going into the ETFs or mutual funds and seeing what the top holdings are, and then you go buy them yourself. There's also something called SMAs. That stands for Separately Managed Accounts. SMAs are where you basically will have your account at, say, Schwab. That's where our clients have their accounts. And you will actually have a manager go in there and buy you individual stocks in your account. They will manage it for you. And a lot of clients like to do this because some of these managers have long-term track records that have outperformed the indices, and it also gives some of our clients more control over taxes and when to realize those taxes, particularly in the taxable accounts. Or even not in the taxable accounts. Some of the ETFs and mutual funds generate taxes within the ETF or mutual fund that are a drag on performance. So if you want to discuss your portfolio and you need help with that, looking over that, you can click on the link below to schedule a call with me. We can talk about your stocks, or we can actually do an analysis if you'd like to do that as well. Thank you for joining us, and I hope you learned something today.